Well, good afternoon, investors, and welcome to our first bull session in the month of May. We are the eve of Cinco de Mayo. Eve, I think. My name is Mark Robertson. I'm joined here by Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. I'm sorry you're having issues, so let's just sit back and enjoy ourselves, okay?
Well, we will just simply, it's kind of, I think it's an abbreviated program today. We shall see, but we just want to have a little bit of fun here today. And again, Matt Spielman is joining us in case there are any follow-up questions to last week and anything else that jumps off the page. We do have some more banking news to get to. We're going to end the session today with a walkthrough of the PROVE calculation, that's projected return on enterprise value, using Middleby as the case study. I think that will be most helpful to a lot of you. And then I ran across some notes that I had made over 20 years ago, where Ken Janke was talking about regret-resistant accumulation opportunities. And I just thought that was a cool expression. So I thought we might spend a little bit of time with that. Regret-resistant. And he was speaking of the times when the stock seems to languish for a while. And Hugh McManus also talks about the opportunity to add shares while the stock price is sluggish. And then we are going to issue an invitation for everybody to share their favorite investcasts, whether they're web or pod. Before we get done here, spend a little time with our lessons from the legends, but I say we just go ahead and get underway. Yes, that is a Portillo's hot dog, and that does go with Cinco de Mayo, Ken, in case you're wondering.
Okay, I seem to have really long arms playing this guitar here, Mark, I'll tell you.
That's okay, I've got really long fingernails. So. All right, let's get underway before we get in too much trouble. All right, Portillo's. Speaking of Portillo's, we were in Cincinnati this past weekend, and we had to remind them that Portillo's is coming to them. And the only purpose for this slide is to say that this presentation is not brought to you by Portillo's, but it should be. All right, here's our standard disclaimer. No Portillo's products on the slide. No investment recommendation is intended. This is all about education. It's about the demonstration and illustration of methods and techniques that have basically been followed by a large number of investors over the last 8 decades as part of the modern investment club movement. So you're going to hear our interpretations and our efforts to understand and deploy the lessons learned over the years. Please do your own homework and make any decisions of your own. If we own something that we're talking about, we'll try to remember to disclose that. We do a monthly webcast called The Roundtable. If you'd like to hear more about that and be added to an email reminder list, send an email to nkavula1@comcast.net. If you have any other follow-ups, a good part of today's program was prompted by a couple of emails. Mark R. at manifestinvesting.com, kavula1@comcast.net. All right. I think we'll go ahead and get underway with our traditional slide. Stocks are perhaps a smidge, highly technical term, on sale. And we do show the average return forecast at value line checking in at about 13%. A little bit of a distance between that and the line of reasonable expectations. So we say that there are a few opportunities to be found. And I just love the quote because I can just see him hunting for opportunities that actually fit this description.
Interesting vocabulary choice, Mark, the word regret resistant. You have to really think about it for a moment before you get his meaning.
Yeah, I would agree. I think what he was basically saying is you have this opportunity. I don't know how many times in my career in fact, I've talked about it a number of times when Chef's Warehouse was at $10. By the time I came back down the stairs, it was at 30. That was a lot of regret that I didn't act before I went upstairs to make lunch. What he's talking about here is is a stock opportunity, a study opportunity that actually hangs around down there at the lower price levels, attractive for sale for long enough that you can actually pick up a few shares. A lot of times we'll see Hugh McManus buy something at 80 and then actually be thrilled that he can add to it at 65 a month later. That's basically what I see this statement as underscoring as a wonderful thing that most investors don't see it as a wonderful thing.
Mark, we used to talk about I-bars that kind of looked like steps rather than look like a line or a smooth curve. If you remember, we used to use Home Depot as a great example of a company that seemed to kind of languish at a particular level in price and then suddenly make a big move upward and then languish again for a period of time, so that the graph for price looked more like stair steps than they did like anything else.
Yeah, in fact, I think I'll just jump ahead a few slides. The two companies, I took the names out just to show kind of what we're talking about here. And I didn't put the full visual analysis on here for both companies, but what you're looking at is the sales track record from 1990 to present day on the bottom for the two companies, along with the stock price, a monthly stock price chart on the top. And I mean, I look at both of these, and how can you not, since we believe that earnings ultimately does follow sales also, believe that stock price follows sales or revenues. Pretty hard to ignore what you're looking at here.
What are the two companies, Mark?
Well, since you mentioned it, Home Depot is on the left, and this is one of those periods right here. It doesn't do it justice, really, because you have to look at it closely. That's a 5-year flat spot. A 5-year flat spot while this was happening down here. So Ken Janke's point, and the point that we've made a number of times, is when you have this situation down on the lower left, along with a flat or declining stock price, you have it here again, but it was, this is a downshift in the company, obviously, along with the turbulence from what happened 15 years ago. But I think it's pretty clear that you can have these type of long-term flat spots. This one on the right is actually Novo Nordisk. We're going to actually talk about them in a little bit more detail in a few minutes. Kind of the same situation, but again, these flat spots, they're misleading. That's a 2-year flat spot there, about 2/3 of the way over on the right on the Novo slide.
I would add too, Mark, given the prominence, well, two other ones. Walmart had about 8 years with nothing doing until just before the pandemic started. They committed to e-commerce. But Microsoft, as well as Microsoft has done, and we've highlighted it before too, just after the .com 2001-ish to 2013 was flat, so more than a decade. I
was just patiently waiting to mention my other example, whoever you are, right? And it was going to be Microsoft. Microsoft was dead money for about a decade or more.
Yeah, a lot of companies in the larger company group fell into this trap right here, the lost decade. So, I mean, that was there for a lot of companies. So any company in that time frame that was operationally getting stronger all the time was getting more attractive. And of course, by the time 2010 rolled around, you actually had some extreme value opportunities. The other thing I wanted to throw in here, just for a grin and a smile, is Ken Janke also was a very avid follower of penny stocks. I'll let that sink in. Penny stocks. But his definition of a penny stock is not the one that you hear about all the time. The one that he always kept was in his shirt pocket, a list of companies that he was eager to buy the next time they missed their earnings report by a penny. So they would miss their earnings report by a penny, the stock price would drop 10%, and then he was all in. So that was his version of a penny stock. He was just looking for a penny of bad news that really doesn't even show up in our studies. And kind of a cool variation on penny stocks. Anything else you want to add to this one, or we'll just go back to where we were? Okay, one quick slide celebrating our visit to Cincinnati last weekend. We just want to say thank you to the core group there in Cincinnati, and we'll stop talking about turkeys for a while now. But Ken, I do think you and I have to get that shirt. Get one for Matt also.
I'll put the other quote on the back. I love the quote that they're hitting the ground like sacks of wet cement. What an audible.
Not good at all. All right, on to this week's tweet. And Matt, I don't know if you're tracking this one yet. You're tracking a bunch of different banks. This tweet came up. I think Sean May sent it over. He's wondering if PacWest isn't possibly next on the list.
Well,
banks to be picked on.
Yeah, so someone thinks so. I mean, there are a lot of banks down quite a bit on what was yesterday's news is the strange thing. But I think PacWest has more to do. Both PacWest and Western Alliance do have a business that involves finance into the venture capital community. Neither of them did it to the extent that Silicon Valley Bank did, because Silicon Valley Bank was basically 100% in. For Western Alliance, it's less than 10%. I know exactly what it is. I don't know PacWest. But there are also different characteristics in terms of dealing with the venture capital companies who move big amounts of money for their business versus the funded companies, the actual operating companies, as well as the covenants that were common but not universal. That if you were going to take a loan out from the bank, you needed to do your cash banking there too, which kept
Right.
the big deposits in place. So I don't know PacWest, certainly as well as Western Alliance. I've scoured news, seen something big reacting. The herd is running. You know, was it a gunshot? Was it a lion? What happened? I don't hear any new news other than saying people might be digesting what happened to First Republic and what it took to make them move, right? If they thought First Republic was safe and suddenly it wasn't, or however they interpreted that,
Mm-hmm.
a little bit more panic there. But it was funny because I was thinking to buy Western Alliance before, and I have a pretty full portfolio position, and at 38, I wasn't there. I kind of had an itch. It wasn't there. At 26, 27 this morning, I was there again.
Okay. Yeah, it's back down just below tangible book. Yeah, one of the reasons I wanted to put this one up is PacWest actually has a fairly decent. This is about a 1.5% return on assets. That's a pretty good run, but it's also some vulnerability during the COVID situation. And of course, they are among the groups that are down pretty nastily with what's going on here in the first quarter. And I wanted to contrast that to Western Alliance. And again, look at the scale change. Go ahead, Matt.
Yeah, both of them also have a significant position of shorts. So PacWest, as of April 14th, short percent of the float was 23%.
Whoa.
Now I will caveat this.
Yeah.
It depends on the data source you look at. 1.43 is an adjusted return on assets. So Western Alliance did sort of clean house. They took everything that they had an unrecognized loss on, and they moved it to held for sale. So they recognized the losses. So I think it's actually 0.6% as a GAAP number for Q1 2023. But that was a kitchen sink kind of quarter. Trying to get it out and not have it be in there. So that is an adjusted number, and it's fair because it was a one-time deal. But understand, if you see something different, that's not necessarily funny business going on. That's just a one-time reaction.
Okay.
And by the time we get to annual numbers, it won't matter, right? It'll be averaged with 3 regular quarters, and it'll be down a little bit, but nothing like that.
Yeah, I think this one is trailing. Ken, I don't know if you wanted to share any nutshells of any of the discussions you guys have had around the regional banks in your investment clubs, or are you still waiting for the mob to cool down?
I I was feeling pretty confident coming on our upcoming meetings until this movement yesterday with First Republic, and then the movement in some of the banks today. I have a feeling this will be a major topic of discussion, and the problem is that deciding on which data you're going to focus on, and again, trying to be reasonable and rational is not exactly what a lot of folks are attempting to do. And I don't know if succumbing to the buy high, sell low strategy is going to sneak up on one of my clubs or not, but I'm trying to get the folks to be a little bit more rational and to resist the urge. They're both fairly small holdings in a pretty large portfolio, in a portfolio large enough to take the whole thing as a loss and still not have that much harm done to it. But it's becoming more difficult at the moment, and I think part of it has to do with a certain tendency by our media friends I've used the analogy before, to see a disaster in every piece of bad news. They're just like the weather guys that when you see a few snowflakes, you're trying to get schools to close because it's going to be Armageddon all over again and again and again. And it doesn't always work out that way. In fact, it usually doesn't work out that way.
Okay. All right, let's go ahead and move on. I'm sure we'll be returning to the regional bank discussion a few times in the future. Here's our Groundhog Challenge. This is our stock selection contest. For those of you that may be new to it, we are given $1 million Groundhog dollars on Groundhog Day, February 2nd, and we buy between 5 to 20 stocks or investments, and then you have to hold it from Groundhog Day to Groundhog Day. These are the current standings. Our friend Kim has snuck into the pole position, and she's actually edged out the group leaders, the Orange County Model Club, and Matt continues to hold down third place, well within striking distance of the leaders. And I would point out at number 10, it's good to see that fugitive return to the list. And we did stick we went down 41 because the cool kids were 41st. Ken, I believe you were at 47.
I thought this might be the week when I popped in, but not yet. So,
the banks are hurting you.
Yeah, I know.
All right, and the gentleman who asked the question about Middleby and the projected return on value calculation, Robert Shaw, Bob is checking in at 37 this week. So, tip of the hat to Bob. All right, so we'll just keep going. Again, it's kind of fascinating to see 2 years so distressing and similar back to back, but we'll just keep cheering things on. Quite a few updates in this group, and as earning reports have come in on at least half of these companies, and we've done some updating of the data and some refreshing. Portillo's continues to gain and look a little bit better, but some of those at the bottom are up a bit.
We have an audience member from Maryland that would like an independent audit of the results of the contest at the midway point, Mark. I'm just letting you know.
So the Maryland member would like to. He's discussed that there are none of the entries on the card. Well, just say duly noted.
Okay.
All right, so nothing major here. I mean, most of these are still performing fairly well in difficult situations. We still believe, I think Ken and I both do, correct me if I'm wrong, that MP Materials might be misunderstood in some of their production capacity type expansion that they're doing. And of course, we're stung by Service First a little bit. I really like the bank. I still like the bank, and we'll see. Again,
I'll relate some information that I have on MP Materials, Mark. It appears that the price of rare earths is being hugely subsidized by the major producer of the rare earths. And that means that China, which produces 80 some odd % of the rare earths in the world, is doing everything it can to keep the price down, which I think the unspoken sentence is, which means even sell these things at below the price that it takes to pull them out of the ground and refine them. But they're doing everything they can to make sure that MP Materials does not get a solid foothold as far as the world market for these materials is concerned.
Yeah, and having said that, we have talked about maybe it's a mistake to kick the Chinese tiger, but it might be interesting to do a commodity type analysis of how those tend to fluctuate over time and the impact that we might perceive for MP Materials. So
I would urge anybody interested in this company to look at their website. They've just put up a new investor presentation explaining what phase 3 and the eventual phase 4 for their mining operation is going to allow them to do. And the one sentence wrap up for what it's going to be able to do is to increase the number of things that it can actually market, because they're going to be able to remove a lot more things than their original focus, which was these rare earth materials.
Sounds good. Well, we'll take a look at that, see if there's anything we can report back on. With that, I think we'll switch to our baseball-inspired hitting with Ted Williams series, trying to hit stocks in the hot spot. These are the 38 topics that came out of the interpretation or discussion of the Warren Buffett 1997 letter to investors. We featured it at our roundtable discussion for St. Louis, and we've actually been having some fun with a number of these topics. We've already touched on the one I wanted to hit today, this notion of patience being critical to successful investing. And again, just a reminder about flat spots. When the stock price is flat, but visual analysis is not, it's definitely worthy of consideration. So just an example of things, and you heard the other examples, Walmart, Microsoft, and there's many others, that accumulation opportunities are a good thing. In fact, one that we'll talk about here in a few minutes, Hugh McManus has accumulated Eli Lilly over the years, and it appears that he may be rewarded in an outsized way with what's going on with the diabetic drugs. But we'll come to that here in a few minutes. All right, Ken, what I thought, it's been a while since we've done one of these, Ken. I thought we would take a look at our modified Greenblatt, or our approach to projected return on enterprise value. And again, this is for industrial companies, not banks or insurance companies. Different formula for that. We basically roll the cash out, but we'll talk about that in another session. And again, this is the metric that we believe can really strengthen stock studies. And part of the reason is it avoids some of the chaos and noise that can be associated with accounting. It does make full recognition of capital allocations and capital structure. We will show, and it's true across a wide berth of companies, that the proof will generally compare pretty favorably to the projected annual return. Of course, we want to explore the exceptions, and it just seems to enable some pretty cool analysis, including companies like Tesla in the past and that sort of thing. So again, it has a lot of virtues and stuff that we've been looking at for years. Bob Shaw just simply asked us to go through and demonstrate the calculation for Middleby. So here we go. just kind of walk through it. Ken, stop me if you see something I need to reinforce a little bit better. What I did here is I grabbed a traditional stock selection guide or Middleby. And one of the things that I will do, and we do at Manifest Investing, is we do it slightly differently. We try to embed the years of analyst estimates in the calculation and the formation of the trend line. So the formation of this trend line actually includes 2 years of estimates. That's what is shown here. Just entered the numbers. All I'm looking for is this basically 10%, this 9.8% result down at the bottom. So we're looking at a company that's approximately a 10% growth company. So you need to grab a trailing 12-month, or you can calculate it from value line. The way we always have this is basically a $4 billion company. And the math to actually make a 5-year sales forecast for a company is right there. To basically take the trailing 12 months and multiply it by 1.098 to the 5th power. So that's 1.098 to the 5th power, and you end up with basically 6.5 billion. And again, the point to be made is we're actually looking 5 years from today. So that's a little bit different. And then one of the things I wanted to illustrate is a lot of times we'll get the question, why is that 6484.6 so different than value line? Well, here's the reason. First of all, it's based on a different percentage that you see here, and it's also a different point in time for the terminal point. So those type of differences can be explained if you look at them carefully enough. And so literally we have the first point of our necessary calculation, or the first half of the first point. Anything you'd like to add to that, Ken?
Yeah, Mark, just one thing. I think we should also make the observation that very rarely will an outlier be pulled out of this data set, so that what you see is what you get. And if you're going to pull out an outlier, you have to be very aware that your calculation sometimes can dramatically change. The closer you come to the present day when you pull an outlier, the more you might be impacting what's going to be the projection into the future. You probably are safe occasionally in pulling an outlier off of the oldest data point, or even the 2 oldest data points, to get the trend line to lie as closely as possible to the data. But I would be extremely careful about pulling any of the dots out of the graph. Leave them, use the trend line as it is, and then see where the approved results.
Yeah, and it's kind of that same old thing. This is the way we do every company at Manifest Investing. And if you ask George Nicholson what he used in Toolkit, you've got the option of going off the latest trend line, the latest quarter. The trend line would have been the answer 99% of the time for him. So there's the first half of the calculation. Here's the second half. We're calculating the 5-year operating margin in dollars. So what you're going to do is take that 5-year sales forecast. You see it down here at the bottom, 6484.6, and now we're looking for one number to multiply it by. This is the operating margin. Now these numbers here are taken from value line. You can see the 21.5 out here, and I've included, just for reinforcement, what that operating margin looks like over time. You know, just looking at this, eyeballing it, anything in that 20% plus or minus a smidge makes sense to me. So we actually have our first point. If you take that 6484.6 and multiply it by 0.215, you actually get our first answer. That's actually the numerator of the equation for proof, 1394.2. Okay, fair enough, Ken?
Fair enough so far.
All right, so now we just need, it's literally just 3 lookups. Determine the market cap. And there's a couple different ways to go. You can either look it up in a place like Value Line. You find it right here. That would be 7,400, keeping it in millions. or the current market cap could be the current stock price times the number of shares outstanding. You notice that we end up in the same place, 7.4 billion, 7401. So we have the current day market cap according to value line in this case. So that's the second point in the 4-point stop. The next lookup, probably the easiest place I've ever seen to find it. There are others. There's ways to find it through the research tabs on the Better Investing tools also. But just simply going to Morningstar, clicking in on your company, and going down and clicking on financials so that you can actually pull total liabilities, and you want the most recent total liabilities, just over 4 billion as is shown here, so 4077.1. So you want that most recent one. And again, we can't underscore this too much. We found in our work that you really want to focus in on total liabilities versus long-term debt. Greenblatt used long-term debt. It just leads to all kinds of craziness. Ken, this weekend, as you made your explanation of what happened with leases and all that kind of stuff and all the tax rules that changed converted debt to liabilities or vice versa, and just kind of muddied the waters many times over. I found myself, my eyes were glassing over while you were talking about all this stuff. If you stick to just the liabilities over time, you don't have any of those gyrations. I would almost call them convulsions. But so pay attention to total liabilities. Anything you'd like to add there, sir?
Nope, makes sense.
And then just down the page, you just have to go down the page, how much cash do they have in their wallet? In this case, they have 162 million in their wallet. You can also pull that off a value line right here. So we have our fourth point. So literally points 2, 3, and 4, quick calculation for point 1, 3 quick lookups for 2, 3, and 4, and we have the numbers that we need. So 1394.2 divided by that sum, I guess it's the two numbers added together, the market cap plus total liabilities minus the cash on hand. It gets you that number of 11,315 for the denominator. So the top divided by the bottom is simply 12.3%. And it's a quick calculation that basically fits all of that stuff that we talked about. So here are the two side by side. This is taken right from some of those worksheets that we publish at Manifest. And what you're looking at on the left-hand side is the proof calculation. Now these are a little bit different by the footnote down at the bottom. These are the analyst consensus estimates. Other things that are going on here are the stock price has actually gone up. So you're going to see little numbers that are a little bit different. The market cap is not 7.4 anymore. It's actually 7.8. So that's there. The liabilities are the same. The cash are the same. So a little bit of jumping around, but still in that 12% frame. Again, using a 9.2% growth rate over here, a projected margin in the 13 or 14% range, and a PE ratio in the 17-ish range, we end up with a number which is virtually the same number, 13.6. So I would basically say 12 versus 13 or 14. Those actually compare pretty favorably. The only time I start getting animated is when it basically drifts more than 5 percentage points away from each other. So if one said 12 and the other one said 17, I might scratch my head a little bit. In a case like this, if we really thought we had more confidence in the projected return on value, I might come over here as I'm doing my stock study and just give deep thought to whether or not I might want a 16 there instead of a 17 for the PE ratio. That will drop this number down slightly. So it's a way of really auditing or gauging your return forecasts and the possibility of fine-tuning your PE ratio a little bit. Your thoughts on this, Ken?
Mark, we're having audience members ask, where can you find proof the actual calculation? Is it being done for the Manifest database?
It is done for the Manifest database. It'll be displayed on the company pages very soon. Kurt's working on it right now. and it is included as a screening parameter, so you can actually screen on it. The calculation is performed for every company in the database, so at least you have it as a screening parameter right now. We'll display it on the company pages soon, probably this week. Okay, anything else?
No, we're up to date.
Okay, so just to drive the point home, again, as you're doing a regular stock study based predominantly on PEs, you're basically leaning more heavily on these. The proof calculation leans more on this one. And again, it's just kind of making the point that it can be quite a tool in our arsenal, because I believe that the top graph is more consistent, more stable, more predictable for our stock studies. So that's the type of thing we're looking at. Just to play it out in your slide decks. Again, you can get the slide decks either on the manifest forum or by writing to either one of us. The calculations are laid out right there with some of the pictures, some of the visual analyses. Okay? And again, some of the detailed numbers, some of the background numbers that we offer as second opinions, that sort of thing, on a company like Middleby. All right, so with that, Ken, I just wanted to talk about a few things that we kicked around a tiny bit in Cincinnati. Just wanted to solidify them because I think they make a lot of sense to pursue. The first one is the cage match. And I think it was you that brought this up with the Cincinnati audience. There's a bunch of articles out there on this happening right now. What's your take on the situation in the cage match that's the lumen large?
Well, if the medical community is correct, they feel that Mounjaro, which is currently approved for treatment of A1C reduction in type 2 diabetes, the medical community feels Mounjaro is going to get a second approval as a weight loss drug. The difference between the two drugs, Ozempic, which is getting a lot of press right now for weight release, and Mounjaro, which is the heir apparent as we move forward in time, the difference is that Ozempic has been shown to yield somewhere between 15 and 20 pounds of weight loss, where Mounjaro has been shown to yield somewhere in excess of 20% weight loss. When you do the arithmetic, there's a very real difference in number of pounds actually lost. Right now, the side effects of both drugs can be inconvenient, but none of them seem life-threatening, and none of them seem something that will be able to stop most people from looking and saying, I'd rather look for a weight loss drug than submit to bariatric surgery, which brings with it another whole host of side effects and behaviors that have to go into maintaining what happens after the surgery. This Mounjaro is a brand new class of drugs and treats type 2 diabetes completely differently. And what it does to help the diabetic is to turn off signals that they're hungry. If you don't have a signal that you're hungry, you don't eat. If you don't eat, you don't gain as much weight. If you don't have as much weight, then you have a better possibility of controlling A1C. And A1C is the total average percentage of glucose that's maintained in the body day after day, month after month. And it's a fairly difficult number to bring down into the reasonable place for most type 2 diabetics. Is that enough for now, you think, Mark?
Yeah, it is. And I'm not sure where this is headed either. I do have kind of a name-dropping situation here. This one might actually rival you accosting that young lady in the mall, Ken. I actually have a high school colleague who is working on the development team for this at Lilly in Indianapolis. And the nutshell description of would be it's simply quite promising and probably ends up in a pretty good place. Now, that's a biased opinion. The other thing that's going on here, Wendy and I own stocks and shares in both of these companies. So it's kind of fascinating to see the intersection. And the other thing that I will point out is that I'm going to mention it here in a minute with favorite webcasts or podcasts. Rick Edelman, the financial planner guru, was on Josh Brown's webcast here, I believe it was last week. And he actually brings this up. And he talks about a number of things, but he's basically talking about quality of life for 70, 80, 90, and 100-year-olds in the not too distant future. And not quite the same as the presentation we made a couple of years ago. He's a little more edgy, but his point is, even if this doesn't work out, the path that they're on actually improves a lot of lives. And right now it's expensive and there are unknown side effects, all that kind of stuff, but it's a path. And then he throws cancer in there, very much like Hugh McManus has done at a couple of roundtables, basically suggesting that the progress being made on cancer is being done very quietly, but it is formidable and it's probably going to end up in a meaningful place. And he spoke of nanotechnology and targeting and some of the genome stuff that's going on. And so I just put this entire thing into the category of humongous potential to actually make an incredible difference in many lives. Now, the estimates on potential sales of these products is as much as 150 billion. And I'm not sure how many years that is over, but it's not inconsequential in the least. So it's something we want to try to understand a little bit better and kind of give a big picture and a micro picture.
Mark, I want to make two other points as well, specifically about Eli Lilly, ticker LLY. If you're interested in what's going on with this drug Mounjaro, I think you owe it to yourself to read about Lilly's pipeline, because this is not the only billion-dollar drug that Lilly has close to being approved for a different outcome than it originally was developed. Lilly has 2 or 3 drugs that are going through the process of FDA approval right now and are very close to the end. Lilly has an extremely healthy pipeline of drugs moving through. And then the other thing is that many of the sources that we use for estimating what's going to happen to a company, if you read very carefully, they are very clear when they say, we do not put the concept into our models of things that might happen. In simple English, that means that a drug that has the power to develop revenue like Mounjaro, once it gets approved for weight loss, is not at the moment being calculated when our analyst community is sitting down and trying to figure out what the potential annualized return might be for 5, 6 years from now. That's an unknown, and it won't be included in the numbers until it is included in the numbers. That seems like kind of a circular way to talk about it, but that in fact is what will be happening.
Yeah, in fact, I think it was 5 years ago, Hugh McManus said we were looking at, I believe it was Lilly, and like a 4% projected annual return. And he kind of scoffed and giggled a little bit. He says, that's just because they don't understand the pipeline. And I think it's kind of coming around to fruition. And this community has at least some of us in this community understand what it means to be waiting for the FDA. And I'm talking about Ardelyx and having approval ripped away from you and hopefully coming back. But this Mounjaro is on the table for this year, hopefully by end of this year. So again, it's a time frame that is uncertain. Don't know what's going to happen. All right, so we invite you.
One last thing, Mark. None of these
Sure.
things are pills. These are injections. We should not be talking about pills. We should be talking about injections.
Right. Until they're not.
Well, it appears that they're going to be injections for quite a while.
Right. All right. So Ken and I would both like to hear what are some of the more entertaining things that you like to listen to as you roll around on the highway, or there's nothing on TV, so you might as well check out some of this kind of stuff. At least that's been my impression. I am down to probably 2 or 3 hours of network TV time a week now. It's just unbelievable what has happened over the years. So we would invite you to share some of your favorites. I've basically given 3 here to start with to get the ball rolling. I really do enjoy Josh Brown, the Reform Broker, and his band of colleagues. That is Rick Edelman there, and second from the left on the lower left photograph. It's an excellent session. I did put a link to it in this week's expected returns update. And again, it's a good listen. It's even more interesting to me to read some of the comments that were a lot more negative than usual. So it's just kind of an interesting way to frame thinking and challenge some of your own biases and that sort of thing. Again, our friend Tom Gardner and David Gardner at the Motley Fool, Rule Breaker Investing, has been a longtime favorite. I don't listen to that one nearly as often as I would like, but that one has been reliable and a source of ideas over the years. And last but not least, and not a direct topic, but it includes economics. So Freakonomics Radio, started listening to that, I think, after you brought it up, Ken, in tandem with that book on factfulness a few years ago. And Freakonomics, you left it out of that.
Great books on Freakonomics, Mark. Just wonderfully, wonderfully interesting books. If you've never heard of the topic, folks, Google Freakonomics and then look at some of the earlier books that were written by this group of people. It's a family business, by the way.
Yeah, and so is Factfulness too, with a father and daughter team, I believe. So, again, what out there do you find rewarding and interesting? And it can run the gamut, but we would like it to be mostly focused on stock studies and investment-related materials, but who knows? Every once in a while you run into something which leads you down a path that can be equally rewarding. All right, and last but not least, we kicked this around just briefly in Cincinnati this weekend, a little bit with the audience, Ken and I a little bit over our lunchtime sandwiches, but this is just a notion. We had talked about the split up of General Electric here a few weeks ago and how the sum of GE Healthcare and GE is definitely shaping up to be greater than the original GE. And again, we were reminded of some of the work in George Gilder's Life After Google. And we had a number of discussions on artificial intelligence. In that book, there's an awful lot also on electric utilities and electrical consumption. And I just think between that and the electric vehicles and the infrastructure questions that are out there, kind of inspired a little bit by our utility bill paying auto payment portfolio. And then just the simple question, why did Warren Buffett buy an electric utility a couple of years ago? And I think all of those topics have the potential to converge and be worthy of exploration. There's a pretty good chance that we should be looking hard at some of these electric utilities as growth engines like they haven't been for 50 years. That's the premise. That's something we want to dig into a little bit more detail. Any thoughts that you want to add to that, Ken?
No, I think you hit it really nicely, Mark.
So look for that. We'll see what we can do. I kind of dread going back to Life After Google because it's not an easy read, but it's a good read. All right, here's just our reminder that we do archive all of these presentations on our YouTube channel. Just search under Manifest Investing. You can also search on Roundtable. All of Matt's work on the double book review is contained in those 3 sessions right there. Our Roundtable from April is there. Still on the page, with the banks continuing to be in a free fall tumble. It's a pretty good discussion of banks back there on March 14th. That's had quite a few views, and it's just a good read, good listen. All right. So with that, I think we'll sign off with the other than the Dogecoin dog, took us all out of the picture and left the dogs to play poker themselves this week in celebration of the last 3 weeks with Matt. Once again, Matt, thank you for your contributions there. It'll be interesting to see where you take that topic.
Yeah. Back to active studying now. Now that we've had a chance to run through it with a broad audience.
All right, Ken, anything else you'd like to add?
No, I'm ready to go out and do some. It's gotten up to like 64, Mark, so it's just really hot here right now. So I think we're going to go out and do some touring, okay?
Well, very good. And I'm going to do some reading up and some tinkering with microphone hardware. All right. So let us know what's on your mind out there. Again, bring your favorite podcast, webcast, investment casts, and we'll look forward to exploring them together. Thanks, everybody.
Good afternoon, everybody.